On InvestTalk today, we look at why the poor export data in China is a red flag. Then we look at how the market closed the week. We answer questions about Abbott, BorgWarner, Staar Surgical, and more. And at the end, I look at the two-speed economy brought on by higher rates.
This is InvestTalk. Independent thinking, shared success.
Now, our main focus point is about the Chinese export data and hit slowest pace in 3 months in the month of July, missing expectations big time and adding to concerns that the Chinese vast manufacturing sector continues to slump. And, does China have a way forward to reorganize their economy to something that's a bit more sustainable beyond just manufacturing and building real estate? They've kind of abandoned the whole real estate for growth type of craze. They realize they've built way too many apartments, basically, especially for the amount of people that are living in China today, much less how many people will live in China in 20, 30 years due to their demographics falling. So the real estate market is going through a slow motion popping of their bubble. And so they're trying to pivot to other parts of the economy in order to kind of bail themselves out. Now, analysts said Chinese factories will likely face stiff pressure in the coming months because of Western tariffs and demand woes due to slowing economies in various places like the United States, where we continue to consume a lot less than we did a couple of years ago. Now, outbound shipments climbed 7% in July from a year earlier. You say 7%, that's pretty good. Well, that's slower than the 8.6% in June. And the forecast was for it to go up to 9.7%. So instead of going up over 1%, it fell over 1% from its June level. Now, imports rose 7.2%, and that was after a 2.6% decline in June. And that's the strongest performance in 3 months, beating the expectation of a 3.5% increase. And the reason that went up is because they're importing a ton of chips in order to potentially skirt any tariffs going forward, against those chips. Chinese imports from the U.S. jumped 24% from a year earlier, in contrast to the 1.7% fall in June. And that's pretty much all chips, that difference there. And so the big question is, what will the Chinese government do? Will they stimulate again? And as expected, the Chinese yuan slipped about 0.2% against the dollar on higher expectations of more stimulus and more of a property slump and fears about consumer confidence around a sluggish economy. Now, the Chinese economy grew 4.7% in the second quarter. That sounds great once again, but below expectations. And their goal for the full year was 5%. So they are not hitting that goal as of yet. Now, what are they doing instead? Instead of stimulating demand for housing, which I think is always a dumb thing. I think that's what politicians miss a lot, both here and abroad, is that they're always trying to stimulate demand. But you know what increases demand? Lower prices. You know what? You know how to get lower prices? It's not just lower demand. It's also higher supply. So many politicians forget that. And so it's pretty interesting to see China kind of abandoning that, which is good. But what they are doing instead is trying to reorganize their economy around internal consumption. And they've kind of done a cash for clunkers. Remember cash for clunkers? They're doing that for not just cars, but old appliances and other consumer goods as well. They've put $21 billion of stimulus in that type of program. And they're likely to do something similar going forward because they want to get people in the habit of getting those nice new things. And then, hey, it's nice to have new things. A few years from now, maybe they replace those again with more new things. So I think it's an interesting policy choice and probably one of the better ones they've had in a while. They're getting new appliances, cars, consumer goods that maybe make their lives a bit better and work better. So this is a big deviation from their previous playbook and something they'll probably continue to go down. Now, another reason why exports continue to struggle is not just the tariffs that we're putting on here in the United States, but it's happening in Europe and emerging economies like Turkey to Indonesia. So many countries are putting up barriers to exports from China because they are worried about their dominance in the global trade market. And so it's not shocking to see their business continue to struggle. Now, what's interesting is that the slowing exports actually had less to do with volume and more to do with prices. Had similar volume of goods, just at lower prices. So the total value of those exports dropped. And what this means is Chinese manufacturers, their profit margins are going down. And that is also inefficient. That can only last for so long. So China continues to be in a rough situation, and I don't think it's going to change anytime soon due to demographics, due to debt, and due to the over-reliance on that export sector. So that's the Chinese market and why, if you look at the stocks, they've improved since the beginning of the year, but it's still in that long-term downtrend. And so I don't see a lot of validity to the decent strength in the first and second quarter, but I could be wrong. Could be the start of something bigger, but the fundamentals in the economy say something else. Okay. Now let's look at the market today. It was a bullish day to close out the week, but nothing too amazing. Large caps were up nearly 0.5%. Small caps were about 10 basis points. Mid caps up about 20 basis points. So mild moves there. As we head into next week, and next week we have a lot of inflation data. So next week will give us a lot of color on what maybe the Fed could be thinking about rate cuts. Right now, it's gotten back to about a 50-50 chance between a 25 and a 50 basis point cut in September. And that's also another thing I would say is a bit overrated, that there's so many other things going on behind the scenes with Treasury, with the size of the Fed balance sheet. All those matter a bit more than the Fed rate cuts. But the Fed rate cuts could spark lending and credit creation, which would be vital. And it's already trending up. That's a positive. Bank credit has been positive year over year for about 6 months, and that's good. You always want to see bank credit creation headed higher, and so that's a positive. And so, why I think we're continuing to be in this choppy period. Most likely, we will head higher through the end of the year and find a bottom sometime in the next month or two. Just because of that government spending, banks are lending. It's hard to have a very bad stock market outcome when money is flowing through the economy at a steady, decent clip. And that's where we're at now. This recent pullback is more of investors getting off sides, the yen carry trade move, blew up some hedge funds maybe, but the average person, the average company isn't really affected by this, okay? And so that's kind of where we're at, but we'll get a little more color next week to see. You have core producer price index, and it's PPI on Tuesday. Wednesday, we have CPI, okay? And then we have industrial production, retail sales on Thursday, and of course, initial jobless claims. We also get import and export prices that day as well. And then Friday, we have building permits and housing starts, and consumer sentiment. So an action-packed week next week of economic data, not on Monday, but basically Tuesday through Friday. And those are the things that are likely to move the market as expectation for rate cuts adjust. Okay.
Hi, Justin. I have a question regarding a company called Staar Surgical. Ticker symbol is STAA. I've never heard anybody say anything about it, and I was wondering your take on it. And it just reported a couple of days ago. Just an overall assessment will be fine. Thank you.
All right, looking at Staar Surgical. This is the one I looked at for a little bit. but it was too expensive at the time. That was back when it was trading at over $100 per share, and it looked really interesting because they have what they do is they make lenses that are for your eye that are installed to help your vision in some way, and they have very high customer satisfaction. So you have to like that, because if their patients are loving them, that means they have staying power. So that's a good thing. But like a lot of things in 2021, it was very overvalued. And I said, let's hold off. Let's be patient on this name. Now it's come down to $38 per share. So patience certainly has paid off, but it's in a pretty strong downtrend, and earnings are headed lower as well. Earnings last year were $1.04 and down from $1.23 in 2022, and it's supposed to be 71 cents this year. So a lot of this is to treat cataracts, glaucoma, etc. And I think this is more of out of pocket. I don't think a lot of healthcare insurers cover this treatment, but once again, it has a lot of customer satisfaction. So that's what interested me, but it's just too expensive still, even at 38. I mean, you're talking at a price to sales ratio about 5.5, enterprise value EBIT of 55. And once again, the technicals are poor. And so you line that all up, it just remains something you want to keep on the sidelines. They are profitable. They are cash flow positive. They have a good balance sheet. Those things are nice. But the rest of it's not lining up. I want earnings to be going up, not down. I want I want the shares outstanding not to continue to go up from the left to the upper right. In 2016, they had 40 million shares outstanding. Now they have 49 million shares outstanding, continually issuing shares. I would like that to stop. So it's a very interesting company eventually to invest in, but the downtrend needs to abate, and they need to get their house in a little better order. And so just because it's top line growth, the profit margins are not there. So I'm on the sidelines for Staar Surgical. Thanks for the call. Let's go talk to Sammy. He is in San Francisco. He wants to talk about investment books.
Yeah. Hi, Justin. Thanks for taking my call. So the question I have for you is, I have two teenagers at home, 15 years and 18 years old. The one who's 18 is going to the college soon. And I just found that she does not understand the basic, of the, personal finance, and all of that. So do you have a recommendation on a book that I can buy for that?
Well, I don't know. A lot of people don't know this, but we actually have a book section on our site, book recommendations. So I would head over there and see which ones you think might hit for her. Might get her interested. There's some classics like Creative Destruction, Extraordinarily Popular Delusions of the Madness of Crowds, Principles by Ray Dalio, etc. Those are some classics. There's also a fundamental analysis section like The Intelligent Investor and more. We also have technical analysis section and an economic section. So basic economics, how the economy grows by Peter Schiff, The Wealth of Nations, Rise of America. There's a lot of good ones over there that I think are good. And then there's some personal finance ones like Millionaire Next Door, etc. So I would encourage you to head over there and try to find some.
Okay, thank you.
No problem. Thanks for the call. Now let's play another caller question now from 888-99-CHART.
Hi, Justin and Luke. I was calling in with a question on the company Abbott Laboratories. The symbol is ABT. Wanted to get your opinion and what your thoughts are getting into the stock, what you think would be a good entry point, and if they are able to pay their dividend. I'll be listening to the answer on your podcast. Thank you.
All right, Abbott Laboratories. The first thing I want to say, and this might be a bit controversial, and you probably will all go what, but dividends are overrated. I just want to state that. It's probably the most overrated way to look at any company. This pays a 2% dividend, so nothing crazy. Its payout ratio is 66%. But I will always stress, because the facts bear it out, that it's not about the dividend, it's about the quality of the business. Now, this is a pretty good business, 14% return on equity. Its 5-year average is around 16%. So a mid to high teens return on equity number is pretty solid. It's usually above the cost of capital and tends to be accretive for shareholders. Okay. And that's why over the long term, Abbott has trended higher. And it's pulled back recently, but overall, nothing wrong with it from a longer term technical perspective, even though it's kind of chopped sideways over the past year or two. It has a good balance sheet, very little debt for its size. It's $5.6 billion in free cash flow on a $200 billion enterprise value. It's about a 5% free cash flow yield, not bad. Free cash flow has been trending higher as of late. That's a positive. And yeah, I think they can pay the dividend. Technicals are fine. I don't think this is the best in the healthcare space, but it's a solid name with once again, good balance sheet, quality business. But that's why I'm buying it. That's why I would give this a mild thumbs up, not over the moon with it. Okay. Earnings this year are supposed to be at 5%, 10% next year on a call it a low 20s P ratio. It's about fairly valued. So a mild thumbs up just because of the quality of the business and has nothing to do with that dividend. Okay. Thanks for the call.
Hi, Justin and Luke. Long-time listener here to your show, Matt from Minneapolis. I don't really have anything in my portfolio for the oil and gas sector in energy. I hear you talking about that, and I feel, from what I've heard, energy in those areas would be a good place to have some holdings in. I don't have the time, I guess, to follow all these stocks personally. I do have quite a few stocks in my portfolio, but I can only manage so many. So I guess what I do in that situation, I don't quite have the resources you gentlemen do, so I look for ETFs. I haven't heard any good stocks in those areas, I guess, mentioned on the show lately or that you give a thumbs up to. So I've found the ETF XOP. I'm interested in what your thoughts and considerations are of this ETF, how you feel about that, and does it contain a lot of holdings in the oil and gas sector that you would be pleased with in portfolios that you work with? Thank you for your thoughts and considerations. I do appreciate it. Have a good day.
All right, looking at XOP, this is the Spiders S&P Oil and Gas Exploration and Production ETF. So these are your E&Ps. They're companies that explore and produce oil and gas. So these would probably weed out a lot of the pipeline companies. It would weed out a lot of the oil service companies, right, that support these E&Ps. And it would be a pure play. Now, it tends to be more volatile than like an XLE because of that, less diversity within the industry, but it does typically have more upside when things go well. Okay, and its top holdings are Exxon, EOG, Diamondback Energy, Marathon, Apache, Valero, Marathon, Matador, Phillips 66, Devon Energy, and ConocoPhillips. And we do own a few of those in our managed accounts. So overall, I have no problem with this. I think this is a good place to be allocating if you don't want to do the deeper research to find the best in that industry. You want to get that broad diversification and just maybe target an allocation in your portfolio of 8, 10, 15%, whatever that is. And I think this is solid. Now, expense ratio is 35 basis points. It's not low, but it's not exceedingly high either for a sector ETF. So it's a good way to get allocation to the oil and gas industry if you don't do the work. Now, let's briefly mention the newest KPP Premium newsletter, which will be distributed tomorrow. And in the KPP Insight section, we discussed the labor market. In the stock ideas section, we mentioned a pharmaceutical company and an engineering company. And in the portfolio management section, we touch on fundamental analysis. And if you're interested in learning more, visit investtalk.com to subscribe, and you will get it in your inbox tomorrow. Okay. Now let's touch a bit on your company stock. Many publicly listed companies pay their senior staff in deferred stock of some kind that vests over a future period, typically 3, 4, 5 years, something like that. Now, in the academic world, they love this. It turns employees into shareholders and reduces the natural, what's called principal agent tension at a public company. And it helps to lock in those valuable employees who, if they leave, forfeit a lot of unvested stock. And this also helps compensate the company for the hiring costs for another a replacement, and allows them to give that stock to that next person. Okay, and what this does is create employees that have skin in the game, and that's certainly important. But is it important if you are a lower level employee? Does it have as much impact on your ability to apply yourself because you're not a decision maker? I think it needs to be more discussed on that front. Regular employees also get stock sometimes. And the big question is, should they sell it when that vests? Now, many don't. Why? Because they expect to sell it at higher prices. But many didn't sell it at higher prices, right? Some people do. They get out at a bad time. Others wait long enough and the stock continues to go up. And it does defer capital gains. But you are likely to have to take that capital gains at some point, unless you want to do like a deferred sales trust. But that's only if you have millions of dollars. So this is a problem that a lot of people are facing. Whether you work at a big bank, for example, or you work at, more often, a big tech company. And most people think things can't go wrong. And the simple answer is yes, they can, even with no fault of their own. By tying themselves to the company stock as well as their job prospects, their income. So it's a double whammy if things go south. And we've seen it happen. And so the diversification argument still has legs, no matter how good your stock is doing today. Just go look at the Dow in the 70s. The vast majority of those companies are gone or acquired at a much lower price. Now, this may sound a bit cynical, but that's the fact. There's one company where employees famously held 30% of the shares. 30%. Internally held by employees. Why? Because the CEO seriously disapproved of employees selling their vested stock. It was frowned upon. If you did that, you were not a team player. You know what the name of that company was? Lehman Brothers. And there are others to point to. Enron, for example. And it doesn't have to be a nefarious thing. It doesn't have to be like Enron. It doesn't have to be something where big management made huge errors. It can just be an industry thing, especially in tech. And my example is BlackBerry. In the mid-2000s, the BlackBerry was everything. BlackBerry was the smartphone until the iPhone came around. And that can happen at any tech company. Within 12, 18, 24 months, BlackBerry went from a behemoth to a company drowning. So make sure that you are not being too tied to your company stock. Let's go talk to Eric in Phoenix, looking at HLLY, which is Holley?
Yes, Holley.
Okay.
Performance.
Okay. Do you own it or looking to buy it?
Yeah, I just wanted to... Oh, go ahead.
Do you own it or looking to buy it?
Yeah, I own it right now.
Okay. What did you buy it? Do you know why you bought it, when you bought it, et cetera?
Well, I like the brand. I like what they do, some of the products that they've come out with in the last couple of years. And I was just calling recently because they had reported earnings, and I thought that they met earnings, or they met the expectation. And I was just wondering, is it because their outlook is poor that it went down today pretty, like 5%? And I think it's below book value, too. So I was just wondering what you thought about that, what you can tell me about that.
Well, let's take a look here. Earnings this year are supposed to be flat from last year, but those expectations are coming down, as well as next year's earnings expectations. Revenue was down 3% last quarter. Earnings were down 29% last quarter. So things are headed south. And I think the issue really has to do with the debt on its balance sheet. It has $556 million in debt on a $357 million market cap, and free cash flow of only $92 million. And it looks like that's starting to peak out last couple quarters. So that worries me a bit. And the times interest earned is only about 1.5. So there's a reason this is trading at $3 per share. It's a penny stock because of those debt levels. And yeah, they had a good time during the pandemic, but that has all come undone. It went public in 2020, and things were rosy then. They made $1 or $2. And this is a good example of companies that go public. They kind of juice the books, right? Make sure everything looks rosy. And then from there, maybe they pull the plug and just get out and cash out. And from there, maybe they don't care too much. And so to me, this looks like a company, frankly, headed to bankruptcy. I would sell it. I would move on. You might like the products, but I don't like the trajectory of the business.
All right. Thanks, Justin.
No problem. Thanks for the call. Now, we've been telling you for a while that our podcast is available in video form over on our YouTube channel, and we get questions submitted over there. So let's get to one right now. Bill JGA says, I've enjoyed your show and have been receiving your newsletter for several years now. BorgWarner was recommended back in early 2023 in the newsletter, and was wondering if you could take a look and see if you think the company is a buying opportunity, as it pulled back around 35% since then, and now at PE of 9.74. Okay, so this is a name that's gone sideways for a while. It's been trading between the high 20s and the mid 40s pretty much since before the pandemic. So it's been chopping sideways. Let's take a look at where we are now with the business. Earnings last year were up 5%, up 1% this year, expected, and up 13% next year. But those estimates are going higher, so that's a positive. $7.3 billion market cap. Let me just bring up profitability and balance sheet real quick. For everyone else out there, this is an auto parts supplier, an OEM supplier. It makes turbochargers, e-boosters, e-turbos, timing systems, emission systems, thermal systems, gasoline ignition technology, powertrain sensors, and cabin heaters. Okay, so they sell to the major OEM manufacturers. And due to higher interest rates, the demand for cars has certainly waned. And I think that's why this has kind of been weak as of late. And earnings are roughly sideways over the past 5+ years, earning about $4 per share. Now, free cash flow is about $700 million, and it's starting to go back up again. It bottomed out in the fall of last year around $300 million. Now we're at $704 million. That's pretty good. I like the recent trajectory there. Return on equity is 11%, which is in line with kind of the longer-term average. So that's it's pretty solid. Dividend certainly can pay at 14% payout ratio. So the 1.5% roughly dividend, that's certainly safe. Pretty solid balance sheet, only about $2 billion in debt on a $7 billion market cap. So it's fine there. And they're taking that cash flow, and what are they doing? They are buying back shares. So I like that. The only thing that bothers me here is the chart. It's just meandering. It's a solid business, good cash flow that's improving. I like that. I think a rate cutting cycle will benefit the auto industry because more people will be able to buy that new car. And the used car market values are falling. And so when that happens, it suddenly makes new cars attractive. Okay. And so I think you're going to see some tailwinds from those lower interest rates. So I would give this, frankly, a thumbs up over the long run because I think it's a solid business overall. I just want the technicals to improve a little bit. And if it can get back above, say, 38, we'll call it $39. If it can get above that, then the technicals will now no longer be on the map and they'll be in an uptrend. So that's where I would buy it on a breakout of 39. Now on Fridays, we generally make time to fit in a quick rundown of some key benchmarks. So let's hit that now. The 2-year Treasury yield, 4.057%, up from last week's at 3.882%. That's showing you that the market was pricing in a little bit of a less dovish Fed due to the economic data that came in okay. The jobs number yesterday, the initial claims for unemployment was the main driver there. And the 10-year yield, 3.95% at the close of the week, up from 3.8 last week. So same kind of sentiment there, but obviously the 2-year is going to be a bit more volatile. Gold prices, $2,428 an ounce, up or down slightly from 2,441 last week. Silver, $27.49 an ounce, down also a bit from $28.56 last week. What else? Oil, $76.80 up on the week from $24.13. And the national average for gasoline, $3.45 per gallon. $3.45 per gallon. That is a 3-cent decrease over last week. Here in California, we're still paying $4.60, but that's down 4 cents from last week and down from $5.87 nearly 2 years ago. So since the start of the Ukraine war, oil prices continue to kind of meander in that 70 to 80 range, which is enough for the oil companies to make good money, but not really scrimp the or strangle the consumer. And so it's kind of in the sweet spot right now overall.
Mark calling from San Diego. Curious about SoundHound, SOUN. SoundHound AI Incorporated. There's a lot of buzz about it, but I'm looking at the fundamentals. It looks like it's off and on earnings, profit, that kind of thing. So just want to get your opinion on it. It looks like kind of a speculative play at this point. Thank you.
Well, like a lot of young AI companies, it is a speculative play. And for everyone else out there, they provide voice AI platform to custom voice assistant for companies to keep their brand, users, and data. So it's a platform that I believe you can use SoundHound's APIs in your applications and run voice through. And I'm not sure exactly what the business is, but obviously, yeah, it has a lot of hype. But obviously, the hype is not translating to profitability. They're still losing money. They've never made money. They're supposed to lose 59 cents this year. That's more than the 40 cents they lost last year. And the debt is minimal. That's good. But what they're doing is they're issuing more and more shares, right? Like a lot of these, I call them Ponzi companies. Wow. In 2022, the end of 2022, they had 200 million shares outstanding. Now they have 329 million shares outstanding. I just wouldn't own this. Now, for a trade, technicals, are pretty solid, actually. I will say that. Maybe it's solid because they're going to get bought out. That's honestly the saving grace here. Because that has a $1.6 billion market cap. If a Google or an Amazon or a Facebook or a Meta or whatever, they see value in their technology, I could easily see them trying to buy them out. And that is what you would play it for. You wouldn't play it for the fundamentals of the business because there are no fundamentals of the business. It is a terrible business as of now. Thanks for the call. Now, lastly, let's talk about the two-speed economy as we head into election season. Right, we only have 3 months until the election, less than 3 months. And for many people, their net worth is at an all-time high. In fact, household wealth is at record levels and investment income has never been greater. But at the same time, many families are running dry on pandemic-era savings, and delinquencies on credit cards and auto loans are on the rise, which means that there are warning signs flashing for the low and middle income consumer. And so when they go to the ballot boxes, I think that's going to be a strong theme. Who can make a credible case that the inflation that they've seen is not going to continue to eat away at their livelihood? Now, a cut in the rates will certainly relieve pressure on certain families. Think of borrowing costs and credit cards and et cetera, being able to refinance loans that may be at higher rates. But it may also stoke inflation again in areas like groceries and auto insurance. Those are the two places that have really hit the average person hard. And wage gains have not kept up. Have only kept up since early 2020. If you take in price hikes. So yeah, people have gotten raises, but in line with the overall inflation rate. And if you go all the way back to 2006, middle and low income Americans generally face faster inflation than their wage. Once again, a large part of that is housing costs and insurance prices. And so the UBS analyst looking at federal data showed excess savings accumulated during the pandemic have been fully depleted for the bottom 40% of earners. Now, a lot of them do have some capacity to carry more debt. That's probably the saving grace here. That's keeping them afloat. But obviously that can only last for so long. So it'll be very interesting to see if that turns around. That's what I'm watching. Is that going to continue to creep up to your higher end consumer? Or will rate cuts actually help that middle and lower end consumer and bring us into a soft landing? And I will be watching that closely and I'll report back. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.